Welcome back, students, to one more session of tourism finance. In our last class, we were discussing about spontaneous finance, which included trade credit, notes payable, trade acceptances, and other stretchable spontaneous finances. So today we'll move on to the second part of short-term finance, which we call it as negotiated financing. So we'll discuss about it today. So this is the second part of short-term finance, that is negotiated financing. So where finance is happening by negotiations. Okay. So first type of negotiated finance is commercial papers. So commercial papers, it is a short-term financing instrument which is used by large organizations which are having a name, an image in the market, and they issue commercial papers, or they issue papers to sell it to the public so that they can get small short-term finance within for period less than 270 days, which are unsecured. Means based on the credit worthiness and the market name, people buy that commercial papers and give that amount to the companies. Then after the completion of the period, with interest, that amount is returned, but there is no security, in the sense nothing is pledged by the company. This type of a short-term finance is used so that you don't have to spend time with negotiations with bank. They don't want to go to banks, follow the procedures and wait for a longer time. And even the interest rate here is much cheaper. So interest rate given to a bank is a bit higher than when you issue a commercial paper. So as there is no collateral security, or they are unsecured, so it is only good for big and credit worthy companies. So when you are going to market it, means when you are going to sell these commercial papers and take amount from the public, we can do it in two types of market. One is called as a dealer market, another one is called as the direct market. The dealer market, here you have dealers, and this is specifically for medium sized and industrial sectors where the company doesn't have direct repo in the minds of the public. Means they are not consumer based industries, they are supply chain industries or industrial sectors where they have difficulty in making the company trustworthy. So they use dealers by paying them an amount of fees. Those are dealers on behalf of the company sell the commercial papers and give the amount to the companies. On the other hand, if you are a big large corporation having a very good repo in the market, your name is known in the market, then you can sell your commercial papers directly to the end users or the public whom you want to get the loan from. But before you sell this commercial paper, that your credit worthiness should be rated by a rating agency. Means the credit agency should say whether it is a 5-star, 3-star, means how good you are in terms of paying amount in time with interest. So unless you are rated by a independent rating agency, you can't sell a commercial paper. The best advantage of commercial paper is low interest rate as compared to bank loans, as I told you before. Sometimes if there is a hitch in the mind of the people about the repo and credit worthiness, the dealers may also take a line of credit from the bank. Means it is an assurance from the bank that this company will pay in future. So such type of a commercial paper, we call it as bank supported commercial paper. So here a dealer, when he is selling the commercial paper and taking the loan from the public or the client, he will show a letter of guarantee, which we call it as a letter of credit by a bank. And this letter of credit, for that you have to pay a certain fee. So it is a guarantee by the bank saying that this company will pay. You don't have to fear. But in case there is something wrong, the bank will take the assurance that they will pay on behalf, but with certain conditions. So as I told you, letter of credit is a promise from a third party for payment in the event of certain unseen conditions are met. So here we have, why I'm saying third party for the bank, because in this agreement we have not only the company, the client who is giving the loan, and the company who is selling the commercial paper, but also we have one more party who is giving the guarantee, and that third party is the bank. So it is frequently used to guarantee payment for an obligation. Means this guarantee will say that after say 270 days or 250 days or whatever it is, the company will pay back the loan. This is best for lesser known companies. Means they are not that high rated and they have a problem in accessing low cost funds. So for them, lesser known medium sized companies, this is the best option. Then the next type of negotiated finance is short-term business loan. So here short-term business loan is of two types. One is unsecured, one is secured. As I told you before, unsecured loans are loans of debt borrowed but without any pledge of any specific assets. Means when you're taking that loan, you are not keeping any of your property as a security or a pledge. Now, what is a pledge? In case you don't pay back the loan, that property will be sold off and the amount will be recovered from that property. So in unsecured loans, you don't have to pledge anything, and it is more so on the trustworthiness and the creditworthiness of that company. Second one is secured loan. Here, the amounts are larger, or maybe even the amounts is smaller. If you're a lesser known company, a new company, then the person who is giving the loan, maybe a bank or any other person, may ask to keep any of your property as a pledge so that you can guarantee payment, so that you not show your back in times of payment. Here we have different types of unsecured loans, or we have certain things we have to take care of while giving an unsecured loan. So one is a guarantee letter from the bank, which is called as the line of credit, which is an informal arrangement between the bank and the customer specifying the maximum amount of credit the bank will permit the firm to owe at one time. So here, as it is unsecured, it will say that, so for say for example 2 months or 45 days, it will say it will give only this much amount, not more than that. Say for example, based is a small company or you is a sole proprietorship, then he may say 50,000 or 1 lakh based on your profitability and your credit worthiness. So amount is maximum this much only will given, nothing more than that, and for a particular part time. 1 year limit is reviewed prior to renewal of the determine if conditions necessitate a change. So if certain conditions are there, they may even give you 1 year limit also. So not for 2-3 months. If they have certain conditions which they feel that you are trustworthy, they may extend the maximum amount of time. Then there is also a cleanup provision where the firm, it requires the firm to owe the bank nothing for a period of time. Say for example, it has given 1 year amount. So the cleanup provision at that time, saying that 1 year, maybe 1 month, it will not give you anything more, or within that time, it have to clear your loan. So that's all for today. I will send you the next part or the last part of this in my next session. So have a good day. Please like, subscribe to my channel to get further notifications. So have a good day. Bye.